The Federal Reserve's two-day policy meeting kicks off today. This is the first meeting after the central bank introduced average inflation targeting, or AIT, at the Jackson Hole Symposium. That followed its first public review into US monetary policy. Now, AIT allows the Fed to see inflation run above target for longer, which in turn could support looser monetary policy. Chris Watling is the CEO and Chief Market Strategist at Longview Economics. Chris, great to chat to you. Sadly, it can't be in person this time. So in terms of AIT, what's your take on this new policy and what's it likely to mean for US monetary policy and in turn the US economy?
Yeah, great question. I think it basically means more liquidity. And markets, of course, love liquidity. And as you said, their aim is to keep it at an average of 2%. If you look at core PC deflator, which is really the key sort of Fed way of measuring inflation, they've been really below 2% pretty much for the last 10 years. They sort of touched on it a couple of times for a couple of months. So, they've failed at hitting their 2% target. They're now trying to make it an average, which means by definition, they'll spend some months above 2%. So it means they've got to be even looser than they were before. So, I think actually when you really think about it and coupled with what the fiscal side is doing, we're sort of doing helicopter money. This is adding a bit more fuel to it, and it adds to the inflationary push that is out there. And I think ultimately we'll start at some stage down the line embedding inflation into the system and getting all those challenges that come with that. So net, it's more liquidity in the immediacy. It's more sort of fuel to this bubble. And but in the medium term, I think it eventually gets you consumer price inflation as well as asset price inflation.
Okay, so I want to ask you a bit more about your outlook for inflation in a bit. But firstly, in terms of the Fed on Wednesday night, what is it that we should be focusing on? Do you think it's mainly the economic forecasts? And if so, what are you looking for there?
Well, I think the economic forecasts are important, but I think what will be more important is the Q&A. I honestly think Jerome Powell, this is the first opportunity they've had to really quiz him about this new monetary policy framework and get into the details and get into the weeds. So I think there'll be a lot of questions about that. What happens if he struggles to make it? What other instruments do they have? How much further can they go? And so on, as well as probably a lot of questions. I honestly think there should be questions about financial stability with the S&P's PE ratio where it is at 23 times forward earnings and not far off its peak in 2000. But they seem to be dismissing that at the moment. They're dismissing concerns about financial stability and they're dismissing concerns about the size of their own balance sheet. So I suspect it'll be how will you get it up to 2 and keep it above 2? How much above 2 will you tolerate and for how long, really? That sort of stuff. And digging into that detail.
And in terms of Fed interest rates, not just this week, but your outlook for the rest of the year, give us a sense of what you're expecting.
Well, the interest rates are going nowhere. I mean, he's made that pretty clear. They're not going anywhere for a number of years. So really, it's about how much do they print and how much do they keep printing. So I'd say they're on hold, for an awful long time until we really start to see the whites of the eyes inflation properly.
So in terms of the markets, you were talking about financial stability there, and it's an interesting time to be discussing that because it comes after the worst week for the Nasdaq since March. I think it was the S&P since June, and it was some of those big tech stocks that have really been leading the way lately in terms of the recovery from this year's lows that have been outperforming that were then taking a major hit. What do you make of all this market volatility? Is just sort of part and parcel of what happens in an uptrend? You get sort of pullbacks and we should expect markets to continue to grind higher, or is this the start of something a bit more sinister?
I don't think it's the start of something sinister. I think it's a close call, but the bottom line is, I think we're in a bubble for tech stocks, and bubbles end when you tighten money, and there's no sign of money tightening, and it's very normal for booming markets to correct by 10% quickly over a week or two. So, maybe the Nasdaq struggles for a couple more weeks, but really, I'm not convinced that the trend is over. And I think there's probably more upside in tech and more opportunity. We're in a bubble environment, and as I say, they keep going till you tighten money up.
And what about the US dollar? Because, we were in a bull market since the start of 2018, then it had an abrupt turnaround. We're now down about 10% from the March peak. What's your view on the current weakness? Should we be bracing for further depreciation?
Yeah, I think so. I think the dollar's pausing. I mean, what the dollar really does is it responds to aggressive looseness or tightness of monetary policy in the States. It's most interested in the US policy. I mean, I know everyone else is loose, but really it's what the US is up to that's key. And we know what they're doing. They're exceptionally loose in a number of ways, fiscal and monetary. And, the dollar came down, 10% or so in a few months. It's pausing because it got a bit overstretched in the near term. It's gathering its thoughts, and I think it'll end up some more downside again as we come out of this, because the Fed's made their intentions pretty clear, I think, in terms of monetary policy.
Let's talk a little bit more about inflation, because you recently wrote a big note about it, about what's happening with price levels and how it kind of interacts with the Fed's behavior. But in terms of the outlook for inflation, are you expecting a rise in some of the Fed's core measures? And is there a risk that that could sort of stifle the economic recovery?
Well, I mean, there is a risk at some stage it'll stifle it, and I think withdrawal of stimulus, whether it's fiscal or monetary stimulus, is a real issue for the economy probably next year. But ahead of that, are we going to get much inflation near term? We've picked up a bit recently. There's a question and debate: is that a reversion to mean, or is that start of a new trend? That's a big question. But I do think if you really stand back from it and think on a multi-year view, we've got classic signs of monetary inflation building. We've got, a lot of money creation. And actually, what's really interesting, if you look at it, you look at household cash flows this year. Normally in recessions, household cash flows contract. This year, they've been expanding at sort of 10, 12, 15% year on year for quite a few months. So helicopter money is putting money in people's pockets and people's bank accounts, and they will be spending it. And I think once they start spending it a bit faster and confidence return, that's when you'll start really engendering some inflationary pressures. So we're back in the world of monetary inflation, money velocity picking up, high amounts of money around. I think that's very plausible over the next sort of few quarters, few years. And I think that that's indicative of the kind of environment we're going into at the moment. It's shades of the 1970s. It's sort of shades of the late 1940s. It's a very different world from the last 10, 20 years.
And just switching tack very slightly, I mean, it's a busy week for central banks aside from the Fed. We've also got the Bank of England on Thursday. Could we expect any sort of market moves around that? Is there anything that we should be looking at specifically in terms of that central bank meeting?
Well, I think the main thing that's moving British asset prices at the moment, of course, is the Brexit debate, as you know. So what is the Bank of England going to do that changes anyone's mind? I don't think they'll do that much, to be honest. I think it'll be more the same from the Bank of England. They may make some dovish noises, but really they don't seem to be in a hurry to do more as we sit. And of course, the government's still talking about letting this furlough scheme run down, which I think is a real issue for the UK economy at this time. So, yeah, I think the Bank of England's a bit of a sideshow. The Fed's much more important here, and maybe even the Bank of Japan, now that we've got a sort of new guy as Prime Minister in Japan. Although I doubt you'll see much change, certainly that quickly, but or indeed at all. But I think the Fed's the main action. The Bank of England's kind of secondary.
All right, Chris, thank you so much for your time, as always.
Thank you. Appreciate it.
And that was Chris Watling, the CEO and Chief Market Strategist at Longview Economics. I'm Victoria Scholar, and thank you so much for watching IGTV.
For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.